All right, it looks like we're already live. So, welcome everyone to Talk About TV, where we talk about all things experiential outdoor hospitality. I am your host, Michelle Oliver, and every Wednesday we come to you to talk about one thing that you don't know about outdoor hospitality. And today I'm so excited to have you here, Kyle Losh with Madison Group. And we're going to talk about what you all don't know about lending in the outdoor hospitality space. We don't know anything about it. Only Kyle does. He has all the secret, all the secrets. So welcome, Kyle. Thank you so much for being here today.
Thank you for having me.
Yeah. Okay, I have four questions I'm going to ask you, and then we'll just kind of see what comes out of that. But number one, here's what we're going to start with, because this is what everybody talks about, right? The interest rates. When are they changing? Why are they not changing? Should I buy? Should I not buy? So, do you have a general update for us on the interest rates?
Yeah, I think interest rates are obviously being watched very closely. That it's a big driver of what people determine when buying an asset. And so we saw the treasuries dip to a 52-week low, which was a really good sign. There was a couple different reasons for that, but they actually tracked it back up in the last couple of days a little bit to correct themselves, which is common. But a lot of drivers are from that. I mean, you had the U.S. unemployment or U.S. employment that was estimated at 185,000 and it came in at 114,000. So very, very low compared to what the expectations was. Now we will continue to see that number correct weeks from now, as they always do. So there's a little bit of risk there if it comes back and it's corrected to 135 or something. You'll see a little bit more of correction in the treasuries and the FHLB rate. Those two rates, which a lot of banks, Fannie, life insurance companies and stuff price off of those indexes, either the FHLB rate or the treasuries themselves. So you'll see that those rates have fallen. The problem that we have in the outdoor hospitality space is Fannie and Freddie are not always the accepting of our assets. So we are really heavily into the bank and credit union side of things to finance those assets. But those lenders that lend on the FHLB rate, it follows the treasuries very well. They're a little harder to find online, but if you Google FHLB Chicago rate or something, those are one of them you can follow. They are down. So the banks and credit unions that price off of that have come down on their rate, which is nice. We're seeing rates anywhere between 6.5% and 7.5% right
Hmm.
now, which is a little bit better
Ah,
than kind of the approaching eights or even 8.5 that we saw.
yeah,
Now there's still some
definitely
banks out
better.
there, yeah, and credit unions that uh, price off of like the Wall Street Journal prime rate or SOFR. Those rates have not come down. That will be driven by the Fed's meeting in September, unless they have an emergency meeting before then, which is kind of being called on. So we'll see what happens there. And then the question really I don't think it's a question of if they're going to decrease the borrowing rate, but how much, either 25 basis points or 50 basis points is really what the market is saying at this point. So hopefully that'll be the first decrease of many, but they're certainly getting a lot of pressure to do that. And then you had a couple other things. The unemployment rate came in at 4.3% instead of 4.1%. That was a big indicator that a softening employment of the U.S. economy. And you have the turmoil in the Middle East that is not really calming down. So there's a lot of risk there. And then a really big driver, which people don't realize, is Japan increased what their benchmark rate was from 0% to 25 basis points. And that was a very big driver because a lot of people borrow from Japan because it's so cheap and invest in the United States to get a return. So when the yen appreciates, it causes a lot of concern for those investors and they pull out sometimes. And so the AI bubble kind of caused that as well. So there's almost like a trifecta that just came in last week and
Ah, wow.
demolished rates. Well, but that probably was a long time coming. And so I think we're going to continue to kind of see that stuff. So I believe we'll see them continue to decrease. It'll take some time, unless, of course, we have a big bubble or something that we wake up one day. But yeah, I think slowly that they'll continue to decrease. 2025, I think, is going to be a great year for financing.
Great. Well, this is the perfect timing to have you on, that all this has just happened. And I love that you just projected a great outlook for everyone for next year. Kyle, so many people in the outdoor hospitality space know who you are. And I jumped right into this just like we're all friends. Everybody knows Kyle. I didn't even give you an opportunity to share why you have all of this valuable information or how you can be so brilliant in the space. Do you want to take just a second and share a little bit about Madison Group? Like, who are you and how do you know all of this?
Yeah, good question. So the Madison Group is a 23-year-old commercial mortgage brokerage company, and we specialize in outdoor hospitality. So we arrange financing on a lot of outdoor hospitality assets, campgrounds, RV parks, true hospitality like hotels, what we call tweeners, where there may be a small boutique hotel and an RV side of things, and maybe some self-storage, and so mixed use assets. And that's really what we have focused on. We have always focused on those assets. I think that there's a real need. Not a lot of lenders can get their arms wrapped around it, and most of us at the company are ex-commercial bankers from Wells, F&B, or Zions, the bigger, larger banks, and we ran CRE divisions there. So we have a lot of useful knowledge when it comes to that, and what everyone would call in the industry is banker talk. And so
Yes.
it helps us get, those unique deals done, and get a lender to do them. So that's a little bit about us. We do it nationwide. So we've done deals in Alaska, from Florida, from Maine to California. So we have a lot of lenders that we work with, primarily banks and credit unions, like I said before, are the ones that finance these kind of assets.
Yeah, you're so good at kind of speaking the language of both worlds and being the translator to the banks because you have such a solid understanding of outdoor hospitality and such a heart for it. So
Yeah.
it's really the best of both worlds, and I'm so grateful that we know you and have this relationship and that you can share with people all of your knowledge. So tell us what kind of deals are you getting done right now? Anything?
Yeah, that's a good question.
Say you are.
Yeah, we are. We actually are having a really good year. Actually might be our second best year ever, which is really,
Oh,
really
wow.
awesome. And most of the deals that we're doing, if they're, I would say from a percentage standpoint, probably 65% of the deals we're doing are refinances because of the hard maturities. $929 billion of commercial loans came due or are coming due in 2024. And just a
Wow.
plug, if you have a maturing loan that matures by the end of the year, get it done now, because we're already seeing some people back out because they've already made their goals. So some banks and credit unions, life companies, they're like, hey, we've made our goal. We're slowing down for the rest of the year. We may be doing select things, or we may not be doing anything. So a lot of the refinances, particularly on the purchases, we are seeing a lot of the value add deals. And I think that still is because sellers are still kind of wanting that lower cap rate that we've seen, 2, 3 years ago. Appraisers are supporting those valuations because their comparables are so, they do a look back of 6 months and in 12 months, or even if they have to go further.
Hmm.
And so when you go back that far, you're still entering into the 5.5% to 6% cap rates in some assets. And so the valuations are supporting it, but the problem we're having is the debt service coverage ratio of the asset is not supporting a high loan amount, like a 70 or 75% leverage, just because of the interest rates today.
Yeah.
So a lot of the deals that we have been seeing are particularly value add deals. Now that could be several different things. I'm buying it. It's got 10 extra acres. I'm going to put, 50 extra pads on it for long term or more transient, or hey, I'm buying this. It has no amenities. I'm putting amenities in it, or I'm going to add golf carts and this, that, and the other thing to get some ancillary income. Or I'm buying it because their rates are really low, right? It might have been a mom and pop kind of shop and they kept rates really low and market rates are maybe 20 or 30% higher. So we've been seeing a lot of those deals. There's a select few of stabilized assets I would say that we are getting done, but just doesn't seem like there's a lot of those transacting because of the interest rates. But I think that will probably make a turn in 2025 as rates come down, as people get more comfortable with the market.
One thing I do like about this situation, if we can look at, the positives, is that it does encourage, if not force people to look at their asset with a more expansive view and really think outside the box and think, how can we add to this property? You're calling it the value add, and really do it CapEx and expansions and all the amenities, and you have to get more creative, and that results in a better guest experience, which is why we're all in this in the first place, supposedly, right?
Absolutely. Yeah, absolutely.
So it kind of
I-
gets your mind where it should be, which is in hospitality and service, and how do we really deliver a great story to these people who are coming to us to try to get away from all these concerns about
yeah,
interest rates and everything, right? They just want to have a great time with their families. So that's kind of a plus to it. And you already, so the third question was going to be, are you seeing more purchases or refinances? And you kind of answered that. Was there anything else you wanted to touch on regarding those two things?
no, I would just say to your point, I think that the consumer actually benefits from this whole cycle, which is
Yeah,
really cool. They don't always, and probably 2020, 2021, 2022, the demand was just so big. People were traveling, the COVID happened and stuff. And so there was probably a little less of the value add of really paying attention to the financials and directing to the consumer. But I think as liquidity tightens in the market, as the Fed's trying to do, people become a little bit more um, conscious of the discretionary income that they have to spend, and they demand a little bit more, right? And so
right.
the folks that own these assets are are having to face what amenities do I have? What do my competitors have? How do I compete with them? To what level? And so it will benefit the consumer. And we kind of always go through these little cycles like that. So unfortunately, in a perfect world, it would be completely balanced, but it just doesn't operate that way. So, but
Yeah,
it's a
the
so
world
it's not all bad.
typically, yeah, no, it's not. And honestly, if you think about all the people that kind of jumped into the glamping outdoor hospitality space during COVID 19, 20, 21, and through now, really trying to take advantage of that, there's a big learning curve for a lot of people. They had no idea what they were getting into. And, it's not just about a few tents or,
Yeah.
cramming in another space for a few more RV sites or whatever. So I think it does lift the entire industry when you have to really step back and take a look at, okay, what's working, what's not working, my loan is coming due. How am I gonna deliver on that? There's so many aspects to this business, and so I do think overall it's good. Everybody learns. It's kind of painful sometimes, but we get better, and all the people that weren't camping or whatever you want to call it, glamping, dispersed hoteling it, getting out there for outdoor, more separated experiences during COVID, there was an education process there as well for the consumer of like, wow, I thought I loved being in a tent, but actually I prefer a luxurious cabin. What do I really want? And then when they're exploring all these assets, they become more demanding, to your point, and then their expectations change. So it's good for everybody. Like we're just always changing and growing and waiting for interest rates to improve.
Yeah,
Right?
and that's what I love about this space. I mean, it's relatively new. You have your traditional asset classes like multifamily or industrial or stuff, but they have been around for a very long time, self-storage, that kind of stuff.
Mhm.
And they're cool too. We work on some of that stuff as well. But the RV park industry, the mobile home park industry, the glamping, even hotels to a certain extent have kind of not really kind of, but they have changed
Yeah.
through this process. And a lot of that has to do with service, amenities, um, and how well they're designed. And so it's really cool to kind of see that industry evolve. I think we
Yeah.
probably have seen it evolve in the last few years more than it ever has. More lenders are getting an appetite for them, so that's really cool as well. 10 years ago when you mentioned an RV park or something, um, probably, yeah, 10 or more years ago, I would say a lot of it was mom and pop. It
Yeah.
didn't have the amenities that you see today. I mean, of course, the Yogi Bears did, and the KOAs maybe had some stuff, but private individual owned normally didn't. And so it's really neat to see the industry kind of evolve to a whole new level. And I think we're going to continue to see that as consumers demand more.
What are you seeing in terms of occupancy and rents with your?
That's another good question. I would say on the long-term RV parks and stuff, we have not seen really any decrease. I mean, a lot of people are RVing and they're jumping from park to park or staying somewhere for 6 months and going somewhere for another 6 months because of the weather. And so the weather has driven a little bit of that, but it always has. In Texas, people are hurting a little bit because it's 100 and some degrees right now. Arizona, you see that.
Yeah.
You're going to see that in the same markets probably every year. And so, you're going to have your snowbirds and stuff like that. But relatively speaking, it's about the same as what we've seen in the past. The transient parks with amenities and stuff that are really targeted towards weekend stayers and weekly stayers have seen I think a little bit of a dip. I don't know what the exact reason for that is. Part of it, I think, is we don't have the stimulus money that people were getting, a couple years back, and that has kind of depleted a little bit. Although that was the Fed's motivation, right, is to get the liquidity out of the market and stabilize inflation. So, I think also some of it is back to the office. You've seen a lot
Yeah.
of CEOs come back out and say, you're either going to the office or you're not. It might
Yeah.
only be 2 days a week or something, but that eliminates those people that were kind of traveling around and staying at spaces. So I think that has to do with it. However, the outdoor hospitality space in the US is a little unique in the fact that uh, in not so great times, that is the most affordable way to take a vacation with your family, the entire family, right? If you've got two parents and three kids, getting them on a flight to fly to wherever is very expensive. I mean, flights are almost outrageous in some instances. So to do that and then pay to get somewhere and then all the food and everything else, it's very expensive. So when people start to look at their discretionary income, let's face it, we had the most sales in RVs ever. So you're going to kind of continue to see people, I think, take more vacations like that versus cruises and all inclusives in Mexico or something like that, just because of the affordability of it. And I also think with the amenities packages that people are implementing in these
Yeah.
outdoor hospitality spaces is going to attract more people. And I mean, because a lot of these are like resort style, they're beautiful. So
Yes.
I think that'll, continue to keep the market in a very stabilized and good situation. We'll probably continue to see a little bit of that trend off in occupancy and rents, but people are just going to have to make the people that own the real estate will just have to make some changes around that, right, to keep things going. But I still think it's going to be very strong. I still think we have a lot of runway in our industry to make it better. And I think the money's there to do it. So
I
we'll
love that. That's a great positive outlook and based in fact, which is the best thing about you. You've got the best of both worlds. And it just makes so much sense, doesn't it? People are yearning for quality of life, for connection, for all of that. And these resorts appeal to every demographic. When you
Mhm.
can bring your entire family and you don't have to worry so much about, is everybody going to be happy with whatever is at that inclusive kind of resort, which it has its place. But this is so much more back to the basics where people are really looking for that. How do I go somewhere with my family and how do we get together and like maybe drop the screens for a little bit and actually reconnect with nature? And I know those are all kind of buzz phrases right now, but there's a reason for that. It's because that's what people want and they're really needing it. So that's a great projected outlook. I'm so glad you came on today.
Yeah,
I wasn't sure exactly what, but we were going to hear, but the timing is perfect.
yeah, yeah. I'm excited. I think 2025 is going to be fantastic. I think there's going to be a lot of transactions that occur, um, and so we have a great outlook on 2025 for the industry.
Great. Well, Kyle, thank you so much. We're trying to keep these kind of short. I could talk with you all day. You just bring so much value to everyone who's hearing this, and I appreciate your time and I look forward to seeing you very soon. And we'll just say ciao for the moment. Okay. Have a
Yes.
beautiful day. Get outside, do something fun with your family.
Thanks for having me. I appreciate it.
Yeah,
Take care.
thank you so much. Have a great
Thank you.
day.
You
Bye,
too.
everyone.